Bruce, welcome to the show, Capital Compounder Show. This is your first appearance. This is episode 2 officially. Everyone, Bruce Campbell is from Stonecastle Investment Management. Bruce, first question. Have you ever seen a movie featuring not yourself, but the other Bruce Campbell from the Evil Dead series? Have you ever watched any?
I have seen one. Yes, it's a pretty popular name. It's amazing what happens when you call different places. I called a call center one time for Dell computers, and the guy knew it wasn't like Bruce Campbell, the actor, but he was just so thrilled that he gave me like super awesome service. So sometimes it works out really well.
That's really cool. So you're home based all the way out in the west in Vancouver, is that right?
Actually, Kelowna, BC. Yeah.
Kelowna, BC. Okay.
Yeah.
Tell me about the pros and cons of being out west in Kelowna, as far away as you can be from Bay Street. Curious.
I mean, that's there's pluses and minuses to it, right? I mean, the plus is definitely that you're kind of out of that, sort of Bay Street rumor mill cycle, like all that, and allows you to independently think and really take a look at, things that are different. So that's certainly one big plus. Now that we have technology like this, it really changes the dynamic for one of the negatives, which was, before like COVID, when I did meetings, it was always on the phone, and so it becomes a much more difficult process to kind of sense emotion and tone and things like that when you're just strictly on the phone. But now that we have all these video facilities, it's much better, and that kind of opens things up like wide open.
Absolutely. And when you want to meet a CEO, you no longer have to get on the plane, right? You can go on video call and interview the CEO and catch up on any company updates there. There's a lot of importance in the name. The reason why you chose Stonecastle for your investment firm. Can you just go into the importance of that name?
Man, I don't know if you've ever named a firm before, but it is challenging because so many names are taken and are trademarked or just taken for your industry. So we wanted to have a certain image, which was sort of that stability and security of something that was solid. And we looked and went down the path of a number of different things in that area. And when we came across Stonecastle, we were like, oh my gosh, this is the perfect name. And then when we searched it and it was available, it was high fives all around.
Yeah, I'm picturing the moat around the Stone Castle, right? And these are the companies that basically are the blue chip sought after companies, right? For one's portfolio. Let's look back on 2004. We're in December now, so we're almost at the end of the year. A lot happened. Of course, we had the U.S. elections, and we had mega caps just getting bigger and bigger and bigger. We had lots of money continue to flow into the tech sector. Those are the trends, and those trends haven't really broken down for years. Do you see any sort of breaking down and any trends changing for 2025?
Yeah, I mean, if you kind of, I think you have to go back a little bit further than that, and you have to go back to almost 2021, and we had so much stimulus in the economy. There was a lot going on, and as that stimulus started to get pulled back, and at the same time we saw interest rates go up, then what it really meant was that those trends in technology started to emerge or really accelerate because of the fact that you had earnings acceleration in those areas. And that's continued along. And I mean, you look at the 800-pound gorilla, or I guess the $3.4 trillion gorilla in Nvidia. And I mean, you look at their last quarter, and I mean, they had amazing growth. They have amazing margins. Like, it's hard at this point in time to poke any holes in how great their business is. And so that trend certainly has been there and continues. If you look at, though, if you sort of dig into this year, it's actually quite interesting when you look at the numbers. So from January to June, to the end of June, the S&P performance was quite strong. I can't remember exactly, but I think it was around 15%. And at the same time, the S&P 600 small cap actually had a negative return over that period of time. And then if you fast forward to the second half of the year, so from July until now, the S&P 600 is up over 20%. The S&P has still done well. It's it's tacked on another 11-ish, I mean almost 12%, I guess here. But you're starting to see broadening out, and I think that's a function of a couple of different things. One is that if you look at sort of smaller businesses, as rates were going up, they tend to have leverage, and they didn't have the cash that some of the bigger companies did. And so what that meant is that their borrowing costs were going up, and at the same time, their business maybe was stagnant or slowing. And so it meant that they had to really rationalize their company and get used to those higher interest rates. And now that they've got themselves in that place, now they're starting to see that acceleration again. And at the same time, you've seen interest rates come down a little bit, and you're seeing some liquidity pick up. And so you're starting to see, that broadening out. And now, the latest catalyst has been the election of in the U.S. And when Trump was announced, I mean, he's very much pro-business and very much against regulation. And I think anyone who's in business, from the one-man show to a small public company, will tell you the same thing, that the regulations that are out there are just onerous and really hurt trying to do business. And so if some of that starts getting reduced, or at least minimized on the rate of acceleration of new regulation, then that's going to help them as well. And I think that's the market sees that and recognizes that as well.
So you're starting to see capital broaden out to the small caps and the mid caps. And would you say that is your sweet spot for the funds that you run, at least the growth fund at Stonecastle?
It is, yeah. I mean, that's where that's where we like to be. And again, if you go back and look at, again, looking at those numbers that I talked about before, if you look at the 25 or 24 year numbers from, for the beginning of 2000 to the end of 2024, small and mid caps have actually outperformed the S&P over that period of time. But if you look at it over the last 4 years, the S&P has doubled the return of those small caps. And so at some point in time, is there a reversion to the mean? I mean, there always has been. Human nature doesn't ever change. It, just tends to rhyme. What we like about, the small and mid cap area is that, you have emerging businesses that, can really accelerate their numbers quickly and, develop something new and are able to adapt. And, that's really where, you see a lot of innovation and a lot of kind of interesting things show up.
Yeah, there's absolutely been a lot of attention in the S&P 500 and investing in the U.S. Basically, that's where a lot of the opportunities are. That's where a lot of the investors are going. You saw a drought in Canada from like 2002 through 2023, especially in microcaps and small caps. There absolutely was not a lot going on. There weren't a lot of IPOs. But we're starting to see the volume pick up, I think, a little bit, right? And small companies in the TSX venture. Talking about a lot of money going to, concentrated space, the U.S., and just a few of the big companies. MicroStrategy, helmed by Michael Saylor. What's your opinion on Michael Saylor's strategy of over-leveraging the balance sheet, just to continually buy Bitcoin? What can go wrong there?
We're having a bit of a cough attack here.
Okay, all good. All good, Bruce.
So, what can go wrong? Well, I mean, there's a couple of different ways to look at that. With the MicroStrategy strategy, I guess, that they're using. So, if you look at it purely from a stock standpoint, man, hard to argue with what the market's rewarded. What's the stock up this year? 500%? So,
Crazy.
If you were a shareholder and you believed in it, it's done really well. If you're a fundamental analyst, I mean, you have a really hard time understanding kind of what's going on there. Because his strategy really has been to, to buy Bitcoin, leverage up his balance sheet to do it, and now the stock's trading, roughly 3 times net asset value of that Bitcoin. And ultimately, like, that's not the business, although he's kind of turned that into the business. And so you have to question, like, why is it worth 3 times more than what Bitcoin is? If he was to liquidate it all, you're basically, I guess, looking out into the future of either what he's going to sell it for or what it's going to be worth. And it doesn't, like, if you're a fundamental analyst, your head just kind of spins and says, well, how can this be worth, 3 times the net asset value? But if you're just a pure momentum trader, I mean, you can't argue with it because you've done really well trading stock.
It's just been a wild ride, right?
Yeah.
Exactly. So tell me about your strategy for the growth fund. If you can just give us an overview of the framework and how you select stocks.
Yeah, I mean, we've got a multi-pronged approach. So what we do to start with actually is we're always trying to figure out, are we on offense or defense with our portfolio? And so we've got a number of different factors that we look at, both economically and market technically, to figure that out and to determine that. And so assuming that we're on offense, then at that point in time, then we want to drill down and figure out, okay, how do we build the portfolio from there? And so we start off by doing a quantitative screen, and we're really looking for revenue acceleration and earnings acceleration, coupled with the fact that the market recognizes that. And so then we rank our universe, and in the US, we've got just under 2,000 companies that we rank on a daily basis. And in Canada, we rank around 700. And we can tell you on any given day, what's accelerating from a revenue perspective, what's decelerating from a revenue perspective. And I mean, it does change daily, but it doesn't change daily in that, companies report every quarter. But we also look at analyst numbers and analyst revisions to also help determine those numbers, because they can push their numbers around intra-quarter. So we're ranking that universe every single day from, in the case of Canada, 1 to 700, or in the US, 1 to 2,000. And then we overlay a technical process on top of that, because we want to see stocks that have relative strength. And we kind of look at 2 different groups that we want to identify. One is the stocks that have the strongest earnings and revenue acceleration, and also the stocks that have the strongest relative strength to the market and to their peers. And then the second thing that we're always trying to identify is the ones that are on the bottom of the list that are starting to accelerate, that are going to go up to the top of the list. And so we're looking for the ones that are there and steady in the top, but we're also looking for the ones that have this huge rate of change, that now all of a sudden there's a catalyst in their business. It might be the the breakout quarter that now is bringing them up, and they're going to end up in the top of the list. And so we're trying to identify those as well. So
That's
we
interesting.
usually kind of a couple of different processes.
So I'm sure for that second tranche, where we're looking for a catalyst, like a company that has a tailwind. You obviously catch it early during the tailwind. You can definitely achieve outperformance there. Can you walk me through a recent example of a company that you did invest in for the fund that would meet that criteria, that there was a catalyst?
Yeah, so this is a company that has been around for a while, and we really liked what they were doing, and then they made a quite significant change. And so the company's called Zedcor. And if you think about, you're a home manufacturer, you're an oil field service company, and then there's a new vertical that I'll talk about in a second. But you need to have your site surveyed and watched, and surveillance on it, because people can come and try to get on your site. They can take tools, they can mess with your hardware, your equipment. And so Zedcor was asked to build effectively a mobile tower for well sites to start with, so that they could be monitored in real time. And then of course with AI, they could set that up so that then they would be able to to see kind of what was coming and going, and whether or not somebody should actually be looking into, the movement on one of those sites. So Zedcar started to roll this out, and they were getting some good traction, especially in the oil field sector, and then started to get some traction in a few other areas. And then earlier this year, they made the decision to start building towers in the U.S. as well. And one of the reasons was because they were getting approached by clients of big box stores. So think like, Lowe's, Home Depots, Walmarts, those type of locations. And now there's such a huge theft problem, like shoplifting problem in a lot of those stores, where they know the thieves know that they're not going to get stopped by the police, because they're not going to get there fast enough. First off, the staff has been told not to, try to apprehend them because it's too dangerous. And so they literally will walk into one of those stores, take a Rubbermaid bin, fill it up, and walk out the front door.
I've seen videos.
And so Zedcor's been hired by, these different companies to put towers up into the parking lot. So now they have full surveillance of it. And now these people are on camera and there's proof. And then there's also the way for them to get tracked down. And so what they've found is that it cuts back their theft in their stores. And Zedcor just keeps ramping up the number of towers that they've made. And what we've seen is, if you look back to a year ago, well, they were just starting to inflect. And now, they went from building sort of 10 towers a day to 15, and now they're working their way towards 25 towers a day. And these things are going out the door as fast as they can build them. It's a reoccurring revenue model. And now they're getting asked to look at, lots of other multiples, or lots of their multiple areas as well. And, so that's one that we identified fairly early on when the numbers started to really change. And that was as they got into this monitoring and as they started to really ramp up.
That's a big catalyst. So not only getting and winning commercial contracts, but you're in the biggest market in the world, right? You're basically selling into the U.S. and the likes of Walmart and other large corporate contracts. Can you give an example then from that first tranche of a more steady Eddie type company that has consistently returned profit revenue for shareholders?
I mean, one that we've owned kind of on and off over the years, and I wish, kind of with hindsight, we had just bought it and held it, is Dollarama.
Mm-hmm.
And I mean, if you look at the numbers of Dollarama, you go back a decade ago now, and I mean, it seemed like they were saturated at that point in time with stores, but they just keep rolling out more stores. They've got into new geographies, and the stock chart just goes up like this. And I mean, if you zoom in, you'll see, blips like, they just reported this week and the numbers were great, but not what the market expected. So the stock was off. But I mean, there's lots of that along the way, and that's a, 5 or 6% move. And on a long-term 10-year, 15-year chart, it doesn't even show up.
It seems
and
like there's no end in sight, right?
Keep going.
Yeah. And, it's not going to get to a point where, okay, Dollarama has saturated the Canadian market. They have that partnership agreement now with Dollar City, right? I think it's 50% or even higher now of that company, and they're growing across Latin American countries. And I think they announced they're going to open up their first pilot Dollar City in Mexico in 2026, another huge market.
Yeah.
So yeah, like the growth probably isn't stopping anytime soon.
Exactly. Yeah.
So you took us to the top of the funnel, right? Where you put a couple or few thousand companies on the top of the funnel, and you work them down based on revenue and earnings acceleration. Walk us through a little bit further down the funnel, some more metrics that you incorporate to get to that set of companies that you finally select for the fund.
Yeah, I mean, a lot of that is inside of that quantitative screen. So we're using, multiple things. Like, I oversimplified it when I said, we're looking for revenue and earnings acceleration. Yeah, we're looking for that. But we're looking for, we dig a little further, we've got cash flow metrics, and then we have valuation metrics in there as well. And then on the technical side, we're looking at multiple time frames. So, Has it outperformed over, 30 days, 60 days, 90 days? What period is that? And then we also look at it relative to its sector, relative to other stocks. We look at relative to the market. And so all of that gets kind of factored in and comes up with, if you said to me like, oh, where's Dollarama? I can tell you, oh, it's, number 56 today in Canada, and last week it was, number, 46, for instance.
And is this a concentrated fund? How many stocks you have in the fund at one time on
Yeah,
average?
I mean, it's all relative. Some portfolio managers run concentrated funds of 10 stocks. We don't do that. We're concentrated. We usually have in our growth funds, we usually have around 40 companies, and they tend to be fairly close to equal weight when they start. And then what we do is we monitor that position size as it grows. If it grows to be too big, we're trimming it back, and then we'll also take time. So for instance, if we own Dollarama and it had a bad quarter, well, maybe it goes from being a 2.5% weight and it drops down to 2.25 or maybe even 2. Well, we're adding back on those kind of pullbacks, and lots of times with smaller companies they can have big blips up. And so we'll also try to be opportunistic with that. So, if, like, say, we'll see a company where all of a sudden there's a new recommendation out on that company by an investment firm, and the stock, has a day where it's up 15 or 20%. Well, we might take that opportunity to trim it back, and we don't just trim it back to like the equal weight spot. We'll trim it back a little bit further, and then if it pulls back, we'll add back to that in the future.
So you're constantly monitoring your portfolio and making adjustments. Um, Tell me about your biggest winner this year. You mentioned Zedcore, but looking back on 2024, what were the biggest winners in the fund?
Over the last year, it's actually been Celestica in our portfolio. They're the contract manufacturer, and they're in the kind of semi. They do a lot in the semiconductor. They do a lot of other technology as well. And I mean, you go back to, I'd have to look exactly to when we first bought it. I think it might have been September 2023. And it was, that if you look at that stock chart, it's had amazing 10-year performance, but it does tend to be more lumpy than say Dollarama, which has just been 45 degrees. And as as everything with AI was starting to really pick up and heat up, and that was going to benefit Celestica, that started to show up in the numbers, and it went, where it was in the probably 350 range in our Canadian ranks, to where it was bang, all of a sudden it was in the top 50. And we added it, and we've done really well with it.
That's super interesting. It's been one of the stars of the TSX this year. I remember when Celestica won, sorry, they lost like a huge contract that they had with BlackBerry at the
Yeah.
time, Research in Motion, and a huge chunk of the revenue was basically dependent on
Yeah.
BlackBerry's success at the time. And then people gave up on the stock, right? It languished on the TSX, and that's really interesting. That fit into your like second tranche, basically. Like there's a catalyst, there's a second life, and sometimes a third life for companies. At the most famous being Apple coming back. And so that's important for a do-it-yourself investor to understand. You could sell out completely of your position, but it's important to put that stock back on the watch list because 5 years down the road, perhaps they find a new market or they launch a new product or service. So that's an interesting insight.
We see that a lot with small and mid cap in probably in Canada more so in the U.S. just because I would say we know the companies a lot more intimately in Canada than we do in the U.S. But yeah, there's companies that we'll have invested in 10 years ago and done really well, and then we might be away from the company for 6 or 7 or 8 or 9 years, and then we're back to it when things start to change and accelerate again because maybe they have a new product, maybe their products come in to vogue, maybe they've done something else with their business, maybe they made an acquisition. It really, you have to always stay in touch with everything. Well, I mean, I guess you don't have to. I mean, that's what we find really exciting and interesting is watching those businesses and seeing what they're doing, good or bad.
Super interesting. It's the beauty about investing in the market, but there's also a dark side, and not everything works out. So for 2024, looking back, what was a company that you're invested in that just didn't perform as you expected it would?
Oh, 2024. I mean, there hasn't been a lot. The one that I would probably point to is a company called Payfare. And so
Important
Payfare,
lesson for the listeners. Very important lesson, Bruce. Let's hear it.
yeah, this is a really important lesson. So Payfare is in the gig economy business. And effectively what they do is they provide almost immediate payments. So if you're if you're a driver for DoorDash and you make your delivery, you don't want to have to wait 2 weeks or a month to get paid. And with Payfare, they're able to provide that immediately. They put it onto a Visa card, and then that is immediately available for that driver to use on whatever they want. And they get paid part of that fee that Visa would charge. And so DoorDash was growing, or sorry, not DoorDash, Payfare was growing, had a couple of clients, and then one day the announcement came out that they had lost DoorDash. The stock was down 75% the following day. I still think that the company, probably has a bright future, but that will take time to repair because they're into 2025. They're going to lose that revenue from DoorDash, and it's hard to replace that immediately. And bang, the stock was down. And I mean, the lesson learned is, that customer concentration, and we knew that there was customer concentration, but with our conversations with analysts, with the management team, no one was too concerned that DoorDash would leave because it was all felt that they had a superior product to what anyone else would have, but it happens. And so that customer concentration is something that, can really hurt. And in this case, it did.
It's super important to highlight customer concentrations. One of the risks that could come up in a company's history, and 75% drawdown is huge. So you have the 40 stock picks in the fund. Do you ever trade around those stocks? Do you have any trading strategies to basically add alpha throughout the year, or is it just basically the 40 or so stocks that you hold?
Yeah, as far as the trading strategy that we use, I mean, a few things that we do is position sizing is important to us. And so we will change that position sizing, but we also tend to be fairly tactical with our technical tools that we use. And so while I mentioned that we had held Celestica and done really well, here where we were out of Celestica for probably around a 6 or 8 week period, and then we went back in, and so it broke down technically, and we sold it, and then it improved, and what ends up happening in a case like that is the fundamental and quantitative ranks it holds steady, but the technical ranks drag it down, and so our combined rank, it dropped in rank, and at the same time broke down technically. So we sold it, and then it came back up through the ranks quite quickly, and we added it back. And since we added it back, it's done, sort of reaccelerated again here. So yeah, we use strategies like that, and then we also, especially more so in the Canadian market, when we talk to management teams, and they'll often, sort of give us an inkling that, oh, hey, if our stock, was to go to a certain price, we probably would want to reduce our debt. And so, we might raise some capital. When things like that happen, we can usually, with our, if our ears to the ground, we can usually kind of massage positions around those events. So one of the things that, we'll often see is that, company's going to raise money, and the market doesn't necessarily know that, but Bay Street does. And so you'll start to see broker initiations on stock. We'll start to get meeting requests from multiple brokers on the street to see if we want to do a call with the company. And, you always kind of have to like raise your eyebrows and say, okay, what's going on? And sometimes it works and sometimes it doesn't. So, I mean, say it's a 3% position in our portfolio, we might trim it back to 2. And, they might do a financing and we're able to, top it back up. Sometimes we miss that, and it just keeps going, and they don't raise, or they raise at a much higher level than where we sold it, and it doesn't necessarily work out to be profitable what we did, but we will do that and sort of trade around positions that way as well.
Okay. You obviously have a big broker network, and brokers are always in your ear, of course. And some hedge fund managers and investors would say, there's only so much value you can get from talking to CEO as well. If we look at the data sources you use, Bruce, what data sources do you use to basically feed into that model of yours? Totally curious.
Yeah, I mean, we use a lot. We use a lot of different tools. Bloomberg, there's a ton of information that you can pull off of Bloomberg terminals, and we feed a lot of that into to our process. We use a couple of different technical charting companies that as well that we can feed into that. The one thing nice about our process is that, like, and I equate it to that show Who Wants to Be a Millionaire. And if you remember the lifelines that they used to have in that show, one of them was Ask the Audience. And the Ask the Audience was right in the high 90% of the time, because it's just sort of that collective wisdom of everyone. And so, quite often what we see when you go back to sort of talking about brokers is that sometimes the brokers, they can kind of believe their own story, and they don't necessarily see. And I mean, this isn't just brokers, this is investors. And I mean, we're guilty of it too, because this has happened to us, where you sort of want to believe, or you believe the story that you're hearing, and you don't look at just purely the numbers, be that the quantitative numbers, or be that the technical numbers.
Mm-hmm.
And by having that ranking system, we're able to really decipher that. And is it right all the time? No, of course there's those ones where it drops down a rank for whatever reason, and a quarter or 2 quarters later it's back up. And there's times when we've got a full load of other great opportunities, and we miss that, and maybe that's the next Dollarama. But by having that system, it really helps to filter out that bias that can come in.
Super important. Like, if anyone's read One Up on Wall Street by Peter Lynch, one of the most challenging aspects of being an investor is filtering out the majority of the noise. He calls it noise, because it's
Yeah.
exactly that. And now with the advent of Gen AI and the introduction of Chat GPT, Bruce, how do you see Chat GPT maybe helping you in the future with the whole process, with what you do?
Yeah, so we've gone down this road quite extensively, and I mean, there's a lot of really interesting AI tools that are out there right now. We haven't found one that we've actually been able to adopt yet. I think we're pretty close, but part of what we do is, when we're combining those two pieces together, and if you remember, I was talking about the fact that we're looking for that rate of change. We think that we can probably get to a place with AI where it'll actually start to identify patterns in that rate of change quicker than we could as humans.
That's super interesting. So as soon as you discover and select that software, please do shoot me a DM. I'd love to know.
Well, there's
Um,
there's there's also lots of software that will certainly you know, take and summarize what's out there. So, you know, you can take there's lots of AI software now that'll like look through kind of the public world of what's out there and synthesize it all down. So it makes it easier to look at, and you don't have to go through maybe all the same uh, depth of information
Hmm.
that we did before, and that's going to be helpful as well. And that's something that, you know, probably the individual investor who doesn't have access to necessarily the same tools that we do will will be able to, you know, adopt that. And, you know, if they say, oh, hey, you know, give me a summary on Zedcore, you know, it'll spit out, you know, history and earnings and, you know, consensus and sentiment and, you know, things like that, to give them, you know, maybe a 2 or 3 page report that they would have to scour around multiple places to find the same information.
Yeah, I'm talking to some do-it-yourself investors, and what they're doing is that they'll download the, let's say, Q4 report from Zedcore PDF format. They'll go to ChatGPT, they'll upload the Q4 report, they'll ask ChatGPT to summarize and provide the key highlights from the report and what changes have happened year over year, quarter over quarter. So super interesting, and there's going to be a lot more use cases and usefulness out of ChatGPT, and perhaps your next security analyst will be entirely Gen AI. Who knows? Um, you've been in the business for a long time, Bruce, and I'm sure you've developed a spidey sense for upcoming corrections, drawdowns. We're talking about the market. What are some clues that a correction or a bigger drawdown is coming throughout your career? Now that you see it in hindsight.
Well, when somebody pays $6.2 million for a banana and then eats it, I mean, certainly the lights are starting to flash a little bit there. Um, you know, it just I guess there's a few things. I mean, how, you know, kind of how and what moves in the markets certainly can have a bearing on that. And I mean, you know, when you look at something like we talked about MicroStrategy up, you know, what it is on the year, and you know, I can't remember how long it took them. I think it was 17 minutes, maybe it was 7 minutes. I can't remember exactly. If you go back and look at the transcript of MicroStrategy's last conference call, it took him, I think it was either 7 or 17 minutes before he started talking about his actual underlying business. So, you know, when you see things like that, you know, probably, you know, are we due for a bit of a correction? Yeah, yeah, you know, probably are. But those are really hard to time, like really hard to time. We look at a lot of sentiment data as well. So we like to look at the um, National Association of Individual or Active Investment Managers down in the U.S. So the NAIM, and you know, anytime that those investors get kind of over 100% invested, and anytime they get probably below sort of 20-ish, 25%, you know, those tend to mark extremes. We can look at, you know, kind of a lot of the, you know, sort of put call ratio data, things like that. But it just kind of the overall froth and, you know, questions that we're getting. And, you know, when clients are getting kind of giddy because their returns have been so big versus, you know, when they're depressed because they're negative on the year, you know, those are always telltale signs as well.
Typically, it doesn't work all the time, but the best time to invest is when the entire market is down and everyone's in the dumps, right? And depressed about the future. Um,
And you know, and interesting, like kind of on our side of the business, and I know we sort of talked about what we would talk about. You know, one of the things you said is like, oh, do you have like kind of an interesting or fun story for the year?
mhm.
And you know, I do, but it's also sad in that, you know, with where we are with our portfolios, you know, we tend to be smaller, mid cap, and those companies tend to be a lot lumpier than most. And
Mhm.
unfortunately, we have a client that came in right at the top in 2021 and also left at the bottom, which is extremely painful. And the bottom isn't like the market bottom that you would probably think about in 2022, but it was more like this year when, I talked about the fact that small caps were still down on the year in June. And we always kind of have, there's always a few clients, if you talk to most professionals, they always have a few clients that are good telltale signs of, when the market's getting too frothy or too pessimistic, because that client will be super excited when things are going up and they want to usually add to their portfolio or take on leverage. And then when things are bad, they're like, oh, I need to go to cash, right? And it goes back to that Peter Lynch, Fidelity Magellan study that was done. And, he had amazing numbers, and yet the average unit holder didn't have those amazing numbers because they were doing the wrong things at the wrong time.
Exactly. It's so important. It's not about timing the market, because who the hell can time the market? Warren Buffett can't even time the market. He's
Right.
admitted it. It's about time in the market, isn't it? It's about seeing a company through, or a whole range of companies in your portfolio. And I assume when that gentleman comes back with the whole bag of cash, he might be thinking that, okay, perhaps we're a little bit too high now. But
Yeah, and I mean, it's, beyond the time in the market, it's also understanding what you're invested in. And I mean, again, one of the things that we always sort of preach to our investors are, we have a specific niche and a specific portion of your portfolio. We're not everything, and we're not saying that we are, like, give us all of your money because we're going to manage it all. We're managing a piece of that, and that should fit together with the other pieces that you have. And they're all going to ebb and flow at different times. And I think sometimes people forget that when they put together a portfolio. But if you look at the biggest pension funds, that's how they manage their money, is they have multiple managers with multiple styles and multiple asset classes, and they generate that, more consistent return over time.
what's an investing rule that you used to live by, Bruce, used to invest by, but over time, as your strategy evolved, you've just stopped using that rule? It just didn't work out. It didn't give you the outcome that you expected.
Oh my gosh. Yeah, I don't know if there's anything that's like hard and fast. I mean, we've definitely changed and adopted our process. Kind of the latest that we did is that, we're always managing our liquidity fairly carefully. And that's part of being a fund, is you have to manage that liquidity carefully. That's a regulatory requirement. But what we saw happen in 2021, and we probably won't see it to that degree again, but when you see interest rates go up at one of the fastest rates ever in history, and you see the money supply drop at to negative, the first time in pretty much anyone who's on the planet's history, the liquidity on a lot of smaller mid cap names disappeared. And so we've put together a lot. We've done a lot of work and put together some tools that'll help us in the future with that.
Excellent. I would love your opinion on this. I'm not going to name names, but there's a portfolio manager out here in Canada who said it's impossible to put together a fund or a portfolio, for that matter, with just Canadian stocks. It's just impossible. You're just not going to see the returns over time. Do you agree or disagree?
If you look at the last decade, I don't know if I'd agree, but I mean, it's certainly the numbers would say that they would be right. If you look at a longer period of time and you sort of take out the bias of the last few years of the number difference, then, I would disagree with that. And in reality, we've found that in the Canadian market, what's ended up happening is 20 years ago, you had individual investors and you had individual investment advisors that went into kind of all different aspects of the Canadian market. So small, medium, large cap. And as compliance and regulation have changed, and it's really dictated by in large part by the banks, a lot of these portfolio managers have just gone all up cap. And so now there's this area of smaller cap that doesn't have the same following that it once did. And so, we can find the Z cores, out there that if I went and talked to 10 advisors, certainly probably 7 wouldn't even know about that company. And yet, it's up, a couple 100% just this year alone.
I completely agree. That's the beauty about the Canadian market. If you're a stock picker, if you put in your research, you can assemble a pretty impressive portfolio on the likes of Dollarama, et cetera, et cetera. But as we've seen in the U.S. and as you mentioned, you could have been a monkey with a blindfold on and just pick the S&P 500, put all your money in there, and you'd have done just well, right? So I think perhaps some of these comments now are there's a recency bias, right? Because the S&P has done so well in the past 10 years.
And if you go back in history and look
Mhm.
at if you just took the TSX versus the S&P, there's gaps of, kind of 10 years where one outperforms the other. And it has to do with, kind of what's in fashion and what's not and the makeup of those two markets. And,
Mhm.
maybe this time is different, as, they always say.
Mhm.
But I don't think it is. And I think that, you'll probably, if we were sitting here in 10 years from now, you'll probably go, oh, yeah, like, I mean, the Canadian market's really performed better than the US. Maybe not the entire Canadian market, but certainly there'll be areas of it that do and have.
Exactly. I'm just waiting for the cover art on the next Fortune magazine to say the only place to invest is the U.S. I'm just waiting for that moment
Yeah.
because I'm a little bit of a contrarian there when it comes to Fortune. Let's get into the really exciting part about our conversation, Bruce. Let's look into the future. 2025, it's coming up. What are your best ideas for 2025?
Wow, that's always a tough one because,
Hmm.
you know, one of the things that we do is that we tend to be fairly reactive to data and information as it changes, and we try to be that way. That being said, I'll tell you what I like, and that might change in 2 months' time. So Zedcore, I talked about it before, but we don't think that's anywhere near penetrating the market to any degree. Like, we think that they could continue to ramp up their production of systems and just keep putting them out in job sites, in parking lots, all over. And it's not just a mobile fixture that they have. They also have fixed devices as well that are permanently mounted in addition to what they have. And they're always exploring new technology as well. So, one of the examples that we heard of recently was that, they were looking at one of the big home builders in the US, and, this is one of those home builders that goes in and builds like, an entire subdivision all at once. And so there might be, 30 homes all on the go, and trades are going between those houses to get them all finished up. Well, Zedcore will monitor those neighborhoods, but they'll also have the ability to like digitally lock up those houses at the end of the day so that, no one can get in. So things like that.
So Zedcore will continue its performance through 2025 is your expectation, at least.
Yeah.
Yeah.
And then just kind of switching gears to a completely different area. And I mean, this stock has also done phenomenally well, but a company here called Tenaz Energy.
Hmm.
And if you look at Anthony Marino is the CEO, and he's done an amazing job. So a few things that he's done particularly well is he knows where where he can create value and where he can't. And so one of the things he's looked at is he said, okay, I can create value in big international pools that are big to me, but small to the majors. So, if you're Exxon or Shell, you might have a field that, is hardly even moving the needle for you. You probably haven't spent any money on development of that field. And so as a result, you just kind of have it on, kind of maintenance. And he can take a look at that and say, that's a big piece of production for me. And if I buy that, I can then operate it and develop it and enhance it and grow it. And so he did that before with his previous company. And then Tenaz started, I think it was 3 years ago now, and they've kept a really, really tight capital structure, which is always important. And what he went out and did earlier this year was he actually secured a deal with a partnership of two majors, and it's in the Dutch North Sea. And so he struck a date when the acquisition was officially kind of not closed, but finalized. And then effectively almost a year later, when he gets all the regulatory things done, he has to pay for it. But what he's been able to do is been able to pay for that with the cash flow from the project. So he most likely won't be writing a check.
Mm-hmm.
And so he's kept his capital structure really tight, and he's going to take on this new field, which he'll have paid for. He'll have cash flow, and then he can turn around and take that cash flow and develop that field. And then he's got other targets globally as well. And just recently, he raised $130 million in convertible debt. Actually, no, sorry, it's not convertible, and just in debt.
Mm-hmm.
And that's an opportunity as well that he could then take that and deploy that into another acquisition without diluting shareholders. So that's one that we think over the next few years could be really interesting. It will be lumpy,
Mm-hmm.
and it's not really well known, so it can trade up and down. If somebody's trying to get into it or get out of it, it moves 10-15% or more on that. And as he makes these announcements, it'll take big jumps up. And it's had a big jump up since he announced this acquisition. So it's one to put on your radar if you don't own it now. And if it pulls back, that's the time to enter it. And if he does another transaction, that's probably really the time to enter into it.
Interesting. And if we can round it out to a third best idea for 2025.
Yeah. So MDA Space is a company that used to be the old McDonald Detweiler, and
Mm-hmm.
they make components for satellites for basically getting into space. And I'm going to totally botch the numbers, so I won't even throw them out there. But if you go online or if you look at their presentation, they can talk about the fact with the real numbers, like how cheap space is got to get into space.
Mm-hmm.
So what that means is it's affordable now for so many more people to get there. And I'm not talking about passengers and people. I'm talking about satellites and installations and like having the ability to have your hardware in space. And they produce a lot of that or components of that. And it's a business that's, because it's come down in price, it's growing massively. And I think this is one that will have runway for the next decade. And again, it's going to be lumpy. Like they're going to have a quarter where maybe they don't deliver the satellites or the pieces of satellites that they need to, and it might pull back. But overall, like their business will be bigger in 2 years, 5 years, 10 years time, and it could be something like the next Dollarama.
Mm-hmm.
If it lasts, it probably gets taken out at some point in time.
And then if we zoom out more broadly in 2025 on the Canadian economy, and in turn this could affect the market, the TSXV. Pierre Poilievre, if he does get elected in 2025 as our next Prime Minister of Canada, good or bad for the market?
I mean, I think it's probably going to be a positive because it's a change, and I think the world recognizes that we kind of have stagnant government right now, and that they haven't done a lot to really grow productivity and output in Canada. And so, even a little bit of change in that direction all of a sudden has that momentum go the other way, and that can have a huge impact because the market has really, and when I say the market, I'm talking about globally, shied away from Canada over the last few years.
Yep.
And so if all of a sudden we see some policy changes and some productivity changes, then at that point in time global investors will start saying like, oh, hey, maybe I need to look at Canada. And that marginal dollar coming in has a huge impact.
Mm-hmm. Completely agree. Fingers crossed, right? We can only hope.
Yeah.
So Bruce, pick one investor, alive or dead. If you could pick one, you could go have coffee with him or her. Who would it be?
I mean, you got to say Warren Buffett, right? Like, I mean, he's, the guy is clearly a legend, done extremely well. Right up there, though, because he's probably a little bit more along the lines of what we do is Peter Lynch. Like, I
Hmm.
would, you can pay to have dinner or lunch with Buffett if you have enough money. But I don't think Peter Lynch does that. So he would also be right up there as well.
Peter's much harder to come by. I think I see selfies here and there on X.com now, where people spot him at the mall or
Yeah.
somewhere at the grocery store. Super cool guy. Some of the best books ever written on investing
Oh,
for
yeah.
the do-it-yourself investor. What's the best part of your job, Bruce?
I mean, there's two parts that I really enjoy. Like I enjoy kind of the competition and the edge of like the three-dimensional chess game of trying to figure out where markets and stocks are headed. One, and two is when we see clients who are really successful by investing with us, that's always super rewarding. The example I'll give you is I remember one time we had a client and she had decided that she was going to buy a condo, and so she was like going to move out of our portfolio to go buy real estate. And I remember the day that she came in to actually pick up a check. This is going back a few years ago now, and she was like she double take took when she looked at the check. She's like, "Is this right? Like, this seems like way too much." And like that's like that's one of those times when we're just like, oh my gosh, I wish we had that on video because it's so amazing. And we kind of have we have a why board in our back office, like why we do this. And one of the reasons is for the clients that we serve. And I mean, that was just like bang on to that.
That's awesome. Changing lives, right? As soon as they see that check and the return so many years later, they stick it out through thick and thin, and there you go. What's the toughest part of the job for you, in your opinion, over all these years?
Yeah, I mean, going back to that, behavioral finance portion,
Yeah.
and that is clearly our behavioral finance. Like,
Hmm.
we can get caught up in that as well. That, when you're getting punched in the face every day by markets, typically you're also getting punched in the face every day by clients because
Hmm.
they're unhappy. And so it's trying to control that emotion when you're getting punched in the face. And then the other side of that is, you know, it's super fun when, everything's going right, but you can't let that euphoria get too high because that's usually when you're about to get punched in the face.
So here's a fun one. You're a do-it-yourself investor. You have $10,000 in the bank. You have a time horizon of, let's say, 20 years. You want to parlay that 10,000 to a million. What do you do? Do you follow your same strategy, or do you come up with a different, more aggressive strategy? How do you
Does
go about it?
does it have to be like only one investment or can it be multiple?
It can be multiple.
Yeah. I mean, I look at what we do, and I mean, right now our numbers don't look very good, and that's, I think a function of where we are in the cycle. And this has been the case in the past, and generally we have really strong numbers over time. And a lot of our peers who do the same stuff as we do are like that. So that's where, that's obviously my interest, and that's I where I typically would gravitate towards. That requires being fairly active, though. Like, I mean, you have to stay up on the companies and
Yeah.
what you're doing. And then, I know it's like super hot right now, and so I probably, you know, I wouldn't go whole heart with it right now, but I do think that, the sort of blockchain, Bitcoin, AI will have a huge impact in the next decade. The issue is going to be trying to figure out exactly who the winners and losers
Hmm.
are in that space. But I would probably want to have some money in in there in a diversified way to take advantage of that. And I think you can see many multiples of your money if you're right.
Yeah, I think some do-it-yourself investors, they get caught up in that get rich quick, and that's one of the reasons why I asked the question, because there's so many variables. You have to really pick the winners. Not everything is going to work out, obviously, and as Buffett would tell us, sometimes it's the tortoise that wins out right in the long run. Um, Last question: what do you like to do outside of the firm, outside of your business?
Yeah, well, if you follow me on LinkedIn, which quite a few people do, you'll know that I'm fairly passionate about hockey. I've got two teenage hockey players. I play hockey myself. I
Awesome.
like to go to the gym. I love skiing, golfing, so fairly active outside. And then, when we get time, love to travel. Or our families traveled a fair bit, and it's always an amazing adventure, both for what you see and what you kind of appreciate, but also the education it gives our family.
That's just great. Well, thanks for the conversation, Bruce. I wish you a very good rest of the year, and we'll follow up again in 2025. Thank
Yeah,
you.
I appreciate you having me on.